Joel, I'm trying to be honest with everybody. I have a huge bias against alternative investments.
Yep.
And the reason being is I like um, I like securities that are priced in a market with a buyer and seller at public markets and transparent markets. Okay. But given that bias, alternative investments seem to be the new shiny thing in the market. We have mutual funds. I'm watching television, and these major mutual funds are advertising their private investment funds for their retail investors. And to me, that seems to be a bad idea because right now I think that alts is a crowded trade, and um, it's the wrong time for retail investors to get involved in it. Your thoughts?
Yeah, Chris, I completely agree with a lot of the risks that you're bringing up. With more, a lot of times they present it as the democratization of alternative investments and getting retail investors more exposure to these. And I do think there's a lot of risk with that. Alternative investments are liquid. There's certain stipulations about needing to be an accredited investor, and there's reasons for that because they're highly risky. What we've seen is increasingly more institutional groups are raising alternative investment funds. Family offices are getting more directly involved in doing private equity and private credit deals. And as you mentioned, a lot of larger mutual fund organizations are also getting involved in alternative investments. I think where we are a little bit different with City Different Investments is we're targeting a smaller part of the segment. We're looking for businesses with between 500,000 and 3 million in EBITDA. Most institutional investors are looking at $3 million and plus. So we really end where a lot of institutional investors are starting. And because of that, we haven't experienced a crowding of the market like you would see a little bit further up the chain. Further up the chain, there's more competitions for deals. There's potentially overpaying for deals to try to drive returns or using excess leverage to drive those returns. In the world that we're working in, we're hyper-focused on a regional market in the Southwest United States. We're looking at smaller businesses, and we see it still very much as a buyer's market. There's a lot of businesses that are up for sale, not many institutional investors that are purchasing these type of businesses. And so we find that we're able to maintain our price discipline with approaching them. We're looking to acquire companies for 3 to 5 times their cash flow. And we haven't seen that change even with the influx of new capital into the alternative investments world.
It seems a lot of risk assets are highly valued at this point in time. And we have just passed Liberation Day. So I'm not going to draw any inference from that. But prior to that, they're sitting with all the equity guys in the firm. It seems that price earnings ratios are quite high by historic levels. As a bond guy, I know credit spreads are extremely tight in the bond market. So investors really aren't getting paid for the risks they're taking on. Do you see the same thing in the alt market?
I think it's very much manager dependent, and it makes it extremely important in that sponsor selection. And as an investor looks to get exposure to alternatives, it's tough to paint the alternatives world with a wide brush, because I do think you're seeing some of that risk premium compression with the influx of capital. I think it's really important to find sponsors that are doing things in a different way, and they're not following the general trends just to get exposure to the new shiny asset class. Whether it's a clear value creation strategy for these private investments, whether it's a unique sourcing strategy to find attractive opportunities that are beneath the radar from a lot of other groups, or something like we're doing where we're looking regional. We're really building off our personal network to try to find opportunities that aren't reaching the broader market. We're trying to find opportunities that we could negotiate directly with the seller rather than going through a competitive bidding process and potentially overpaying for some of those assets. So I do think across the board, you will see some of that risk premium or some of that return premium, compressed with this influx of capital. But we're trying to do everything we can to stay disciplined of what we're doing, fly underneath the radar of a lot of the more institutional groups, so that we could still maintain delivering those attractive risk-adjusted returns that people expect from alternative investments.
One of the other things I'm concerned about is that oftentimes the sponsor's interests are not aligned with the investor's interests. So, especially with an illiquid security that gets valued periodically during the year, maybe semi-annually or quarterly, uh, their eyes are more on AUM, so they don't want to write it down. I just was reading an article recently. Big mutual fund, non-performing loans in the fourth quarter went from 9% to 14%, causing disruptions in that product. How is CDI and your approach different? And could you outline that?
Yeah, it's a huge risk, and because the managers do have a lot of discretion, because there's not an active market, the manager or the sponsor has a lot of discretion of determining the value of their portfolio company. And if they're compensated based on the value, there's a misalignment of incentives between the manager and the actual investor. So a few different things. First of all, we're working with only accredited and qualified investors that understand that illiquidity. I think secondly, our compensation structure is not at all tied to the actual underlying value of the assets. So we have no incentive to overinflate or underinflate, for that matter, the value of our portfolio companies. The way that we're compensated through our small business acquisition strategy is based on the distributions that the portfolio companies actually make. And so we think it's a great alignment of incentives between our investors, the portfolio companies, and ourselves as an investment management firm. Is we're only receiving compensation if we're distributing cash. We're not getting compensated based on AUM. So if the value of the portfolio company goes up, that doesn't necessarily affect us in any way. With all that being said, we do still strive to provide updated valuations for our investors on a quarterly basis. We do update the valuations of our portfolio companies. Those valuations are audited on an annual basis as well by a third party. But ultimately, what I think is most important is that our compensation is not at all based on our discretion of updating the portfolio company values. It's more so on the distributions that are actually coming out of these businesses is how we're paid.
Great. Well, look, full disclosure, my wife and I are investors in one of our private firm acquisitions, and we've been quite happy with it. In conclusion, have I missed anything? And is there anything you think I should have asked you?
No, I think you covered it really well. I think a lot of the risks that you pointed out are spot on with the alternative investment industry at large. And I think it's important for investors to look at the industry with a level of scrutiny. It's a shiny object right now. And we've seen this with many different asset classes where something's very attractive in the early ages. And then as more money flows into it, it could bite people down the road. And so I think it's important to really understand the manager that you're working with, understand if they're taking a differentiated approach, understand if their incentives are aligned with you as an investor. And our strong preference at City Different is working with managers who have a long-term focus and are not driven by short-term incentives and short-term gain at the LP's expense. So I'm really excited about what we're building here at City Different. We're looking for small businesses to acquire, and primarily in the Southwest. And we think we have an opportunity to provide a lot of value to our investors as well as the community that we live in here.
Well, I think that speculative investments do have a place in a well-diversified portfolio. Just you have to be careful the percentage you're allocating to them,
Yeah.
and make sure it jives well with your risk tolerance as an investor.